I have to say that I truly fear that the US economy is essentially a leverage play on seven stocks. And if those seven stocks really crack, Jack, I think we could see US growth, confidence, all driven by wealth effects, implode.
So you're bull on gold, but you're bearish on Goldilocks.
What I'm saying, particularly to US investors, is think outside the box.
This episode of Monetary Matters is brought to you by VanEck Semiconductor ETF, ticker SMH. As you may know, SMH is the largest semiconductor ETF by AUM, with over $25 billion in assets under management. But what you might not know is that SMH has historically outperformed its largest competitor, SOXX. In addition to SMH, VanEck has launched SMHX, a first-to-market fabless semiconductor ETF that's been intelligently designed to capture low capex, high-margin chip designers, setting the next stage of AI. You'll hear more about both later in the show. Let's get into it. Joined once again by Julian Brigden, co-founder of MI2 Partners and Macro Capture, which is a research partner of Monetary Matters. And Monetary Matters can get 10% off by clicking the link in the description and using code MM10 for annual and MM10Q for quarterly. Julian, great to see you. Welcome back to Monetary Matters.
Thank you for having me on the show, Jack.
So, Julian, you write in Macro Capture about the dominant narrative we have in markets right now, where the labor market is fragile, but not too weak. So it's fragile where it's fragile enough where it allows the Federal Reserve to cut interest rates, but not weak enough where we have a recession. So basically, the Federal Reserve is cutting into a strong economy, and this is just a boon for all risk assets. So stocks, gold, everything, Bitcoin as well is going absolutely bananas. What is right about this Goldilocks soft landing narrative? And what, Julian, is potentially wrong about this narrative?
I think the setup is incredibly interesting, Jack, that we have essentially a perfect Goldilocks Nirvana soft landing priced, where we have just about enough labor market weakness, not too much, because you can't have too much, because if you lose control of employment, game over, recession, right? That the Fed can cut just about enough that they don't overstimulate to reignite inflation, right? And that fits with this sort of very benign kind of bond outcome. A still pretty benign setup in sort of inflation expectations. Yes, inflation expectations are raised if you look at, say, 1 year swaps, but then they slowly come back to sort of kind of to target. And at the same time, we're running this, somehow we managed to square this with running this sort of massively easy financial conditions and blistering FOMO rally in everything. Now, I'm a personal account, I'm loving this because I'm long a lot of junk. I've got gold miners, silver miners, junior silver miners, silver, XME, all of this stuff. And it's blowing away the performance of sort of US stocks in aggregate. But it's quite hard to square that circle, because certainly when you look back at history, the statistical odds of Goldilocks are low. Jack, what history tells you, if you go back 75 years or so, is that the odds are after a tightening cycle, you end up in a recession. The Alan Blinder, who's an ex-Fed governor, did a study, I think back in 2022. They went back and he looked at the last 10 tightening cycles of the Federal Reserve. And if you exclude COVID, because that was a little bit of an anomaly, we hope, he came to the conclusion that the Fed has nailed a soft landing 40% of the time. I think that's a little overly generous, and I will tell you why. In one of those outcomes, in the mid-60s, which he claims was a soft landing, inflation massively reasserted itself, resulting in them having to absolutely slam the brakes on and push us into recession at a later point. In one of the other ones, which is in the 90s, very early 1990 or mid-1990, they had been tightening. They started to ease and then we went into a recession. Now, there was a small oil shock related to the Gulf War. But I think that damage done from that tightening cycle, together with a relatively small exogenous shock, Jack, was enough to stick us into a recession. So if you aggregate this all up, you've had 10 tightening cycles. I think that 7 of those led to clear recession. So that means you've only got a 30 delta that you're going to avoid recession. Now, in one of those, inflation took off again. To me, that's not a soft landing. Okay. And that leaves the odds at 20% using history, which is not really great from a betting perspective. Now, when you stand back and you say, which one of those, so we've got 10% chance inflation reaccelerates, 70% chance that we go into a recession, and a 20% chance that we hit Goldilocks. When I look at the pricing in markets, it truly is absolutely Goldilocks. So we have, basically, depending on the day, another sort of 100 plus basis points more of rate cuts, 125, something like that. And then they stop. And we have obviously an equity market that's loving this, taking off. And then when we look at the inflation picture, say if you look at inflation swaps, yes, it's quite high for the next year, but then it gradually kind of comes back down. Doesn't really drop quite to where the Fed, I think, legitimately claims they want it. But I think we could argue the toss on whether they really want it there anymore, Jack, or not, right? But it is this incredibly benign kind of outcome. So when I look at the economy, there's really only the thing that typically tips you over is, and what makes getting soft landing so incredibly tough, Jack, is that the labor market is a momentum indicator. You can literally run moving averages over unemployment or unemployment type metrics, and you can kind of look at when you start to see unemployment rise or claims start to rise, right? And at that point, once you go, I mean, it's the whole idea between the behind the sort of SARM rule, right? Mm-hmm. Essentially that once you lose that employment momentum, you're screwed, right? Straight to jail, don't collect your $200, you're in a recession. So when I look at that, there's definitively warning signs, right? We have unemployment above the moving average, typically is recession rate. We have particular elements of unemployment, of the employment markets are well above. So teen unemployment, graduate unemployment, right? Minority unemployment is beginning to tick up as well. But what is bizarre about this cycle, and crucially different potentially about this cycle, is we don't yet have the layoffs. And what typically triggers that, the next step, along with that loss of momentum, we also have a policy backdrop where not only the data, as I said, that I find incongruous with this assumed Goldilocks outcome, but the policy outcomes couldn't be more incongruous with this concept of this sort of very benign, business as usual, no vol, right? We have an administration, rightly or wrongly, and I think in many respects, a lot of the things that they are trying to achieve are highly laudable, but they are also insanely radical, Jack. And not to assume that those in and of themselves could either create this sort of, that your tail risks haven't risen materially. I mean, you have a big fat tail risk, base case tail risk after a tightening cycle recession. But this concept that we could get if we avoid the recession and then we start to reaccelerate next year with very low unemployment, no immigration, so no growth in the labor force, right? That somehow we couldn't get an acceleration of inflation again, right? I think I just look at this Goldilocks and go, really? It doesn't sit with me, Jack. And I can only put it down to an element of cognitive dissonance, Jack. The final kind of et tu brute stab that knocks you over is some sort of exogenous shock. So we talked about, in the 90s, you got that oil shock. But typically outside that, what typically occurs is weakness in the equity market. And one of our firm views is what we call this hyper-financialization, this just acute, tight relationship between the behavior of CEOs and the real economy, whereby essentially as stocks are rising, they're hiring and they're doing CapEx, and as stocks are falling, they're firing and cutting back on spending. And we clearly don't have that, Jack, right? So,
because the equity market's rallying like crazy.
Exactly.
Yeah.
So when I look at this setup, don't get me wrong, I think there's a fragility in the labor market. But until we see those layoffs, it's very hard for me to say, aha, the base case is a recession, right? And I want to envisage a situation where, let's say that the president is correct and that we cut back on some of this uncertainty. And so early next year, we've kind of cruised along here, right? We've got an equity market that's higher, no big problems. We haven't burst a bubble. Everything is fine. We start getting the tax refunds, which should be good. The big, beautiful bill starts to kick in terms of deregulation and all this sort of stuff. We obviously know we've got the AI infrastructure spending, but more importantly, we now have accelerated depreciation allowances, which should really encourage CapEx. And CapEx in aggregate, if you look at it ex-aircraft, ex-defense, has, despite AI, is still pretty anemic, right? It's still pretty weak. So envisage a situation that next year that actually growth is starting to pick up, right? Now, I think the concept that we have addressed and defeated inflation, where core CPI is basically still the highest level in 30 years, is a joke, Jack, right? Is a complete and utter joke, right? So we have an accelerating economy, sticky inflation. Now, typically, maybe we could go through the arguments of whether AI is going to kick in the next 6 months and make us all unemployed, right? And we'd just be avatars talking to each other, Jack, right? That's another question. But let's envisage sticky inflation, economies reaccelerating. Now, we have very low unemployment, 4.3%. And the only time in history where we tried to accelerate the economy from this level of unemployment, with actually quite a similar macro backdrop in terms of the supply of labor, was the mid-60s. And inflation ripped again. Now, I'm not saying that that's the base case, right? But I think if I look at those odds of a recession versus an acceleration of inflation again, they're probably skewed much more to like 30%, 40% maybe a recession, 30% 30 to 40%, a reacceleration of inflation. That's kind of my hunch. I don't have all the components yet. And the odds of a soft landing still incredibly low, right? And what worries me is if we do get that reacceleration of inflation, when you look at what's priced into bond markets, and a lot of this is going to be path dependent on whether the administration gains control of the Fed, right? Another topic we can talk about. But I actually think we could have a real bond revolt, and then I fear some policy steps that could really push us into a quite Wild West situation. So when I look at this and go, do we nail what is the equivalent of a central bank perfect 10 at Olympic gymnastics? The somersault with the tuck, landing on our tippy toes and get that beautiful soft landing? I just don't see it, Jack.
So you estimate a soft landing roughly in that 20 to 30% range, much lower than the market. And you
At
think
best.
A reacceleration is in that 30 to 40%, excuse me, a reacceleration of inflation is in that 30 to 40% odds and a 40% chance of a recession. That's
I mean, look,
interesting.
that's just
As far as I've
this.
known you, you've basically been a, what Johnny Matthews would call himself, a recession denier, always pushing back against the near ubiquitous recession case. And so
Yeah, I just don't. I don't see.
you're a recession. You're becoming a little bit of a recessionista now. Not to use
Well,
that as
I
a slur.
wouldn't say that, Jack. I mean, look, it's
Yeah.
a lot of path. There's a lot of path dependency here, Dan. I would say there's until we get that exogenous shock, no. So if what I'm doing is really, if you start off with a base case that you should, after a tightening cycle, assume that the odds of a recession is the base case, right? What's happening is that that base case is receding, and the risks of a let's say that 20% chance is still roughly of the soft landing is staying the same. Then what's moving up is that reacceleration of inflation as we try and reaccelerate growth with very tight labor markets, right? And that's the point, Jack. If we were coming out of typically when growth reaccelerates is after a recession.
Mm-hmm.
And typically at that point, you've got like 7, 8, 9% unemployment. And so you can expand growth with no threat of higher wages because you have plenty of labor slack. We have none, right? And I am fully in Jay Powell's camp when he said the reason basically the non-farm payroll number headline rate is down is there is no supply of labor, right? Because that's all about hiring, right? And I know there's not that much hiring going on, but there would be more, I think, if we had the right people, right? The next step is going to be, as I said, I'm raising my risk that the economy reaccelerates. It's going to be degree of data dependence. When I look at my models, they're sort of moving in that kind of direction. It's not the dominant position yet, Jack, but it's moving that way. But what is not changing is the odds of a soft landing, and yet that's what the market is utterly priced, right?
Well, I certainly agree that, Julian, that if the price of oil goes to $120 and that we see inflation hit 7, 8, 9%, of course, that's going to be a pretty unfriendly environment for stocks, at least in the short term. But what about if something that could qualify as a reacceleration of inflation, which is roughly between 2.5% and 3% now, does accelerate up to 4%, but the Federal Reserve is cutting rates or at least not hiking rates, and you have a situation where inflation's at 3.5%, 4%, interest rates are at 2.5%, 3%, and Nvidia is selling hundreds of billions of GPUs a year. Corporate profits in the S&P are very high. Is that really an environment in which a bearishness in the U.S. stock market is going to be rewarded?
No, it isn't. But what happens in that environment, Jack, is I make an absolute bloody killing in my junior silver miners, right? Mm-hmm. Because in that environment, the dollar gets annihilated.
Yes.
Right? I mean, look, I think what people need to understand is macro is a sort of series of forces that work concentrically on an economy, right? And they press from various different sides. And if, like the sort of proverbial Dutch boy, you go and stick your finger in the dike to stop the pressure building, to stop the water coming through there, what tends to happen is the pressure just shifts. So and I think this is not an insignificant risk, Jack, let's envisage we've got that situation next year. We've got an economy which has gone through some people have called this like a mid-cycle slowdown, right? We go through this mid-cycle slowdown, growth reaccelerates. We find that wages start to tick up from already pretty high levels. 3.5% to 4% is actually quite high historically. Those typically correlate incredibly closely to core CPI. It's core services basically is what wages drive, and that's like 75% of core CPI. So we end up with this, very, very sticky headline core prices, and maybe start to move up towards, as you said, 4%, right, or more. And yet the Fed is essentially doing, financial repression, right? For however they do it, either whether they're cutting rates a lot and just doing like that, what you would expect in a normal environment, Jack, is you would expect the long end of the bond market to go, right? And you just end up with this curve that looks, like a vertical line, right? As bond investors go, wait a second, mate, you're running it hot. You're not protecting my long-term interest because you're going to let inflation burst. So I'm not going to buy your long-dated. I'm not going to take the risk in the long end of the curve. Now, I suspect that this is something that this administration would not like. I'm not saying they're wrong. My job is not to say whether policy is right or wrong. It's just to interpret the consequences. And I think there is when you look at the trajectory of the debt, Jack, I think there's a very logical, cogent argument to be made that we need to run this thing blisteringly hot. If we cannot, which is what Doge told you, cut spending, then the only way we dig ourselves out of this financial hole is essentially we run nominal GDP well above our funding rates, right? Because if you don't, you end up in a debt spiral. Right?
But what if you cause that increase in GDP growth with fiscal stimulus, which makes the debt even bigger? And I'm not illogical. I think a Keynesian, basically, I think tax cuts and spending are basically the same thing in terms of increasing the debt and increasing GDP. But is that really sustainable?
No, it isn't.
Yeah.
But you have tools, right? We have seen periods in history where that has occurred, right? So if you look at the Second World War, we were blowing out the deficit and we capped bond yields, right? If you look at the late 1960s into during the Vietnam War, the Fed actually conducted essentially QE, which they called back then money debt financing, and essentially they artificially suppressed bond yields, allowing the government to fund the spending. Now, it had big consequences subsequently, Jack, because we blew up Bretton Woods, the currency system, and the dollar imploded. But it was the right thing to do, right? Financial repression at times is societally the right thing to do. We could be at one of those points, right? But it has consequences. And our job is to help people navigate through those consequences. So if they're running it hot and they're suppressing bond yields next year through either, just artificially cutting rates and keeping the curve, because there's a natural limit to how far 10-year yields or 30-year yields should kind of rise. And if those get out of control, maybe they're slewing issuance even more to bills and keeping that, or they call it fiscal QE, right? Or maybe we get the Fed does QE again, or they mess around with the mortgage market, which is being rumored, or we get yield curve control in an extreme environment, right? All of those things are possible, mate. But that's just going to shift that pressure in that dike from this hole to this hole. And this hole is going to be the currency. And in an environment where the dollar is falling, historically, US growth stocks have been absolutely the definitively worst place to be invested. Not the best place.
Because the rest of the world is so long US equities and US tech stocks.
Yeah, I mean, look, I think, what we've seen is we were, I think, one of the few shops at the start of this year who said, if we get an equity wobble, which we were expecting, we started to look at one in sort of November, we were starting to see signs of concern there. The dollar this time will go down, not up. And the reason for that is very simple. All the money in the world is here, right? We have been running inordinately large budget deficit and significantly current account deficit, particularly since 2020, since we went on our fiscal blowout binge, starting with President Biden, but continuing under this administration, where we are just importing like crazy because it's mostly being, the wealthy who are doing that, and they have a high marginal propensity to import because they like their German cars and their foreign holidays and, so on and so forth. And Scott Bessent is absolutely right that we should address this when he said, last year more people went on holiday to Europe from the US. And at the same time, more people are subsisting on food stamps. And that's clearly morally just bloody wrong. Right?
I agree.
So, addressing these things is important, Jack. My job is just to figure out the consequences. And I think, right here, right now, am I super bearish the dollar? No, we're sitting at these multi-year trend lines, and we sort of keep coming up to the edge and coming back, and it's a bit bloody frustrating. But when I look at, and a lot depends on, does this administration gain control of the Fed next year? Are they going to be able to push out Lisa Cook in time for the February re-election of the regional Fed presidents, which is going to be a key event because we have these 12 regional Fed presidents who come up every 5 years to be reinstated. And typically it's just a rubber stamp and they just roll over and roll over and roll over. But what we're hearing is the Trump administration is applying pressure to the boards of those regional Feds.
Really?
To pick administration-friendly candidates. Okay? I mean, I'm not saying they're all going to be Stephen Myron, right? But, run it hot, kind of call it friendly candidates. And if they're successful at gaining control of the FOMC by February, which removing Lisa Cook is going to be key to do that, then it's possible that with the 7 member, the board of the Fed then picks who they want, or accepts who the regional board put up, right? That you could end up with a de facto much more, let's say, administration friendly, run it hot friendly FOMC. And in that situation, I think that's the scenario that we just painted is game on. If they don't, Jack, then I think there is a risk that some of this euphoria around rate cuts fails. Because I think it's possible that we get a couple more rate cuts and then the Fed just goes, well, look, unemployment went from 4.3 to 4.1. Why do we need to cut anymore? And then you have to start questioning everything that's priced into the front end of the bond curve, which I think could be problematic for the equity market, because I think it's a very key point are those rate cuts. So I think next year becomes tricky. I think it becomes a great macro environment. I think ultimately, let's say the Fed did back off for those rate cuts, I suspect we'd get an equity correction in that point. So you get volatility first, then they'll have to come in and do something because that will catapult you into the recession. And that's when the dollar will really go. So it's a question. I'm a structural dollar bear. I think, I think we've had a great run. It's very expensive by historical standards. We're barely off in nominal terms in a broad dollar, not just against developed currencies, but in a broad dollar off basically 40-year highs, right? So when you look at EM and throw all that in there, we've got an absurdly strong dollar. It's come down a bit against developed market currencies, 10, 11%, but that's nothing in the scheme of things, Jack. And so that's kind of where I think the play is. It's just that path to get there. Do we just go straight there? Right? Because they gain control of the Fed. The administration artificially suppresses rates. Or do we have to have this kind of cat and mouse fight? Equity market scare, and then we get there. That's kind of the challenge.
Hope you're enjoying today's episode. Semiconductors have driven decades of innovation, resulting in massive efficiency gains in the global economy and powering tech giants such as Google and Amazon. SMH by VanEck is a focused ETF that captures the whole semiconductor value chain, from top-tier designers like NVIDIA and Broadcom to foundries such as TSMC, through the equipment makers and software developers. Its market cap-weighted, concentrated approach has helped SMH outperform historically its closest peer. Go to vaneck.com/SMHjack to learn more. Building on the design and success of SMH, VanEck saw an opportunity, and it launched a fabless semiconductor ETF, ticker SMHX. It gives investors targeted access to the high-margin, capital-light segment of the semiconductor market. The fund focuses on chip designers that outsource manufacturing and are driving AI optimizations and applications at the edge. Go to vaneck.com/SMHXjack to learn more. And now, back to the interview. So you have, as everyone knows, been a dollar bear. The dollar index this year is off, well over 10%. Since we last recorded, it's basically flat. Went down, went up. You point out that year to date, the European stock market in dollar terms has beaten the S&P 500, which is really interesting. And likewise, the Chinese stock market has absolutely crushed the S&P 500 as well. What does it indicate to you that so many foreign markets in dollar terms are outperforming the US?
So I've called this kind of money illusion, right? I mean, if you want to see a very extreme example of this, during the Weimar Republic, so Germany, when you had hyperinflation, you were running around with money in wheelbarrows, right? But the equity market was going up hundreds and thousands of percent, which meant that it wasn't going up in sterling terms or dollar terms. It was just going up in Reichmark terms. Why? Because at the end of the day, Krups, the steel manufacturer, was a perfectly good company producing exceptionally good steel. So why all of a sudden just because the denominator of that Reichmark was imploding, why should you be able to, as a British buyer of steel, suddenly get absurdly cheap German steel for fractions, for pennies on the dollar, right? It didn't, we saw the same thing in Zimbabwe in the 80s, right? In the 90s, when they had hyperinflation, they produced tobacco. And so land prices just went up hugely in Zimbabwe. And I've had a couple of clients who made an unbelievably large amount of money doing that by buying like tobacco plantations. So
I think I may know who one of those is, actually.
Yeah.
Wait, I'll cut it up. Raditi?
Well, yes. Nick was
okay.
one. This is the point. So I think when American investors look at their portfolio, they really, and this is an argument I have with wealth managers, right? With wealth managers, right? RIAs, that wealthy people have here in the US to manage their money. And like in your title, there's a clue. Your job is to manage wealth. Okay. So if in 5 years from now, you go, well, you're up 20% on your S&P, right? Or you're up 30% on your S&P, but you're down, the dollar is down 30 or 40%. So in my trip to the Amalfi Coast, I can no longer afford. You've done a shitty job at managing my wealth, right? And so this is what typically happens. So when you have a weak dollar, Jack, what typically happens, particularly I think is a risk this time, given the acute overhang of foreign money in the US markets, right? We've seen the liabilities of the US, so the assets that sort of foreigners own in the US, rise $20 trillion, rise 50, and that's a 50% rise in the last 5 years, right? So these are just mind-boggling amounts of cash, right? And not all of that's gone into the equity market. About a third has gone into the equity market. There's still shitloads of money, Jack, right? So if you start to see dollar weakness, which is something the administration wants as part of resetting the current account deficit, part of rebalancing the economy and re-onshoring, right? Some of it's going to get hedged. And we've seen stories on Bloomberg about more foreigners hedging. But there is an awful lot of that money that does not get hedged. Mr. and Mrs. Schmidt, who sit in Germany and a long some sort of global tech fund, and they've done exceptionally well in the last, few, decade. Mr. and Mrs. Olsen sitting in Stockholm, Mr. and Mrs. Watanabe sitting in Tokyo, who all have the same investments, because that's the only way we've been able to run the deficits that we've had, is that people have been willing to fund them, Jack. They will not hedge. And at one point, they will look at the returns of the S&P or their tech fund in Swedish krona or yen or euros and go, oh, it hasn't gone up. Or maybe it's even gone down, right? Which it has for many foreign investors this year, right? In their currency terms, US stocks, some US indexes are down, right? And this is the thing that people don't consider. And the other thing with, as I said when we started talking earlier, Jack, typically growth stocks are the worst things to own in a weak dollar environment. What you should really own is you should own value, because the thing about growth and all these tech names is that despite the name, typically you own them when there is no growth, right? You pay up for an Nvidia or a Google because it can grow at 15, 20% when the rest of the world is buggered, right? Yeah. But if you are cutting rates and the dollar is falling, it is typically what I would call the lifeblood of the global economy. It's the denominator of copper prices, and it's what determines how much flow typically goes into emerging markets. And all of those things, those kind of cyclical trades, and it's exactly the same with the play on the Russell, which a lot of American investors are trying to do. In a weak dollar cutting environment, those are the things you should own. You should own the cyclical things. And when you consider the weight differentials, right? I mean, really, that's what you should own. And you don't have to pay up to get that US tech. And I'm looking at, when you look at some of the extremes. So one of my favorites is, I've been long PA, and we've recommended it to macro capture clients, XME, which is the mining and metals ETF. Incredibly low. And we've recommended it having against the S&P, but the one that I like is against XLK, which is the tech ETF, right? So in the highs of the last time the dollar was weak, the ratio of those two was basically 25, right? The ratio of those two at the moment is 3, Jack. Is 3, right? So if you're in the weak dollar camp, which I think we're entering a multi-year period, as I said, it's a bit choppy, right, of dollar weakness. If I think that ratio can go from 3 to 25, that's an inordinate return profile. And, as I like to call it, when you look at some of the chart porn that goes with that, those charts that make you sort of go, ooh, actually against tech, mining and metals have massively outperformed.
Massively.
So far this year.
Yeah, total return tech ETF XLK is up 22%. Not bad at all. Very good. No. The minings and metal ETF XME is up 60%.
Right. And this is typically, literally the high on that ratio was back in 2008, and then we had another high when the dollar made a low in 2011. And then obviously in 2020 and COVID, things got a bit wacky. But the recent low corresponded at the beginning of this year with the dollar high. So it's completely a really aggressive play on weak dollar. And I'm not saying to people, don't be invested, but what I'm saying, particularly to US investors, is think outside the box. Because I'm not saying that the US becomes this sort of, post-apocalyptic world, right? Where the dollar is never the reserve currency.
Yeah. You never
You know,
said that. You never said that.
I lived in New York from 2002 to 2008. I had a great time. I thought it was a great place, but it was a crack time to be invested relatively in the S&P.
Yes. And the mining's a metal ETF up 60%. I think a lot of that is gold. Like, I think the industrial and base metals are, not done amazingly this year at all.
Started their trade yet.
Yeah. I mean, the biggest one is VanEck, a sponsored mine, but the gold mining ETF GDX is up 119% as we record. Julian, the elephant in the room, let's talk about it. Gold. Why is gold up just so much? Is it because everyone in China is buying it? Is it because there are real concerns about the long-term fiscal and monetary stability of the United States that so far we've been talking about? And why now, Julian? Because these you could always make a reasonable sounding argument about concerns about monetary and fiscal stability in the United States, but what about 2025 is really bringing these issues to the fore?
I think people are starting to realize, Jack. Look, I mean, I've been long gold for a long, long time. It's been an integral part of my portfolio. I haven't owned Bitcoin. Maybe I missed out on that. I'm just a bit of a long-term, doomster in that sort of sense. I worry about that Bitcoin is so good that it enables you to sort of circumvent the system, that if we ended up in some really sort of bad place, government much more ability to clamp down on that. So, look, I'll admit that I missed out on some of that, but gold's done very well. I think it's beginning to show signs of really starting to outperform Bitcoin, and silver is even starting to show signs of starting to outperform Bitcoin. But these trends have been in place for a long, long time, Jack. I mean, we played them aggressively for the last couple of years from a trading perspective. But when you look, for example, at the relative performance of treasuries against gold, I have this just killer chart where it looks at the total return of treasuries, so including the coupon, right? You've been way better off in gold for like a decade. I mean, I call these instruments of confiscation, right? The bonds, right? We had a very, very overvalued bond market. I still think globally and structurally, the bond market is overvalued. It doesn't mean if we go into a recession that you wouldn't end up with a rally in bonds, but I think structurally we are in a structural global bond bear market. So in that kind of situation, you have to look, and also, Jack, the other thing is that the correlations between bonds and equities are starting to have broken down, right? And the reason for that is very simply that in times of inflation, bonds don't act as nearly as good of a hedge as they do in times of deflation. So from 98, when Greenspan first came in and kind of got concerned about moving to negative interest rates, and did QE and basically started to focus on pumping up equities over controlling inflation. And it took a long time, Jack. It's taken till like 2020 for that relationship to truly reverse. But prior to that, we'd never had periods where bonds and stock prices were negatively correlated. They were always typically positively correlated because inflation went up, bonds went down, and central banks hiked to crush demand. So they killed the equity market. And so I think we are back in that kind of world again. So bonds are not acting well. I think people are beginning to wake up. I think there are concerns around, and we can see this across a multitude of countries, US, UK, France, Japan, right, around the money goodness of long dated bonds, right? I think that's an issue, Jack. But I don't want to get over hung up and say, anyone's going to default, because they're not going to do that. But I think, these are tiny, 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 tiny markets, Jack, right? Like I said,
the gold market is tiny relative to the S&P. The gold market is tiny relative to the bond market.
Yeah, I mean, like I said, you could buy the whole of XME, all that mining and metals ETF, for 3%, basically, of the tech ETF, right? The tech ETF. So it's just, these things have the power to move again and again and again. And history tells you they can go up. They can have 100% outperformance and another 100% outperformance versus call it paper money, right?
Yeah, I mean, gold over the past 3, 5, 10 years. I mean, you don't have to kind of rig the game and start it in 2000 when gold started its epic bull run.
No.
Like, of course, gold has crushed bonds. It's crushed the long bond. It's crushed cash. Of course, yes, absolutely. And even interestingly, I just took a look that over the past 3 years, so out of the bottom of the 2022 bear market, gold has actually beaten the S&P. Julian, earlier this year, obviously you were very bullish on gold and silver, but you did say a note of caution. You said tactically that you thought that it was very overheated. This was in April and May, and it was overheated. It did take a breather. Describe the evolution of your tactical views on gold right now, as well as do you think that it is overheated on a basis? I'm sure if we look, I haven't checked, but I'm sure that it is technically oversold and maybe a little overhyped. So even though you're long-term bull, but do you have a note of short-term caution that it's gotten a little overheated?
Look, I mean, this is the bit about parabolic moves, Jack. You sort of sit there and go, "Ooh, right." It's like, you're going up in the roller coaster, and there's a top coming, right? And the higher you go, the more you grip that handle because there's a whoosh. But you have to kind of grit and bear it. I mean, look, there is no question that in the current sort of buy anything market that we're in with, and as I said, junior silver miners are a bit like buy anything, right? That we are going to have a fall at some point, a correction. What exactly that trigger is it the Fed turning around and cutting once more and going, you're done? Is it a high inflation print? Is it a higher employment print where everyone goes, oh my God, we're not getting 125? Is it bad NVIDIA earnings? It doesn't really matter what it is, Jack, right? This is where managing risk becomes key. And yes, I mean, I was cautious back in the spring. We'd kind of lost momentum. We were starting to see, and look, all markets are momentum plays. Equities are momentum plays. And it was rolling over. When you lose momentum, if you go back and you look at the big highs of 2007, 2000, what you see is literally your moving averages just get closer and closer and closer and closer. And at some point they start to cross, depending on what moving averages you're using, Jack. And, this is something that we've disclosed to the macro capture audience, is they crossed over. And when they cross over, be very, very careful. And they were flirting with those levels back in the spring. And then we got the pivot, right? And, because no one thought, like we were saying back on the eve of the election, this is an administration with a really aggressive agenda, right or wrong. You're completely underestimating tariffs. And people were like, nah, it's going to be fine. There's no way you do that, right? Now, I do think, and as I said, I know certain members of the administration. I think they are, some of them are very sensible. I think they have some laudable objectives. I think they thought that they would take some pain up front, Jack, right? Get maybe, through tariffs, through Doge, right? It is essentially an austerity because tariffs are basically some sort of VAT, no matter how you cut it, right? It's a sales tax, basically. And then you cut spending, that is a deflationary impact, or arguably a stagflationary impact. So you get a correction in the equity market in 2025, but bond yields drop, and then you can kind of term out the debt, right? And then you can light a fire underneath the housing market, and then you can do all the deregulation and all the big, beautiful bill stuff in 2026, and you'll just surf this like resurgent economy into the midterms. And what they clearly didn't figure out was the impact on the bond market.
Right.
Because that sucker yields were supposed to go down, not up. And so I think that's led to a change in tack. And that's really what led us to change our view and cause the next breakout. And we had some technical signals that started to, as I said, the momentum started to turn down, and then it shifted back up again. And we're like, the average returns when you've seen that technical signal trigger is like 30% in US stocks. But I think it's lazy just to pick the bloody S&P. I think there are, like I said, I think I prefer to own my XME and junior silver miners. Bit of a ballsy call, but I think it's, that's what you're there to do, right?
Well, it's certainly worked out very well. So, Julian, on the bond market, what are you seeing and hearing in the data and from your contacts with regards to the flows? I know that for only a handful of days in early April, the flows from the bond market were very negative. Japan was pulling their money, Europe was pulling their money. I didn't look at the data subsequent to that, but I saw in the price, the bond market stabilized and the equity market stabilized, and obviously is in a huge bull market. What is the concern from, say, the wealth managers in Norway, who I learned from you are very long the S&P, or the institutional investors in Japan, who are very long the U.S. bond market? What is that pull that you've been referencing to sell or be a net seller, meaning in terms of new assets, they're just reducing their U.S. exposure? Talk about that trend to pare down their exposure of dollar assets.
So I think when it comes to the bond market, there's an element of the US, right? But then there's also, Jack, in general, as I was saying, I mean, it's not just the US that is having problems, right? When you look at Japan, when you look at, elements of Europe, UK, France, right? Those countries are all having long dated bond issues. And there is this expression or word within the bond market, fungibility, which basically boils down to the fact that you can essentially recreate one sovereign bond with another, just using a currency swap. So I can essentially create a sort of pseudo gilt by taking a treasury and swapping the currency exposure. And so none of these things really move that far out of whack, Jack, unless you're really concerned about credit risk, right? And there shouldn't really be that much credit risk in these between these governments, because they can pay you back in their own currency. But so I think that's one issue, and I think I've had long conversations with large clients who back in the spring were saying things like, "Look, I don't think the trajectory of the deficit." And this is before maybe some of the tax money came in, so the tariff money started to come in. The trajectory of the US deficit or the UK deficit rewards me for taking a lot of long-dated, duration-rich risk, right? One client said to me, "I'm not extending," this is a big multi-billion-dollar, hundreds of billions of dollar global real money bond fund, who said, "I am not taking any risk beyond 5 years in the US. I would much rather take the risk in Brazil because I'm compensated in terms of yields, right? I'm getting, teens in for my yields, not single digits, right?" And I think that's definitively one issue, Jack, right? And I think people have understood that there are, and that's why gold is doing well. There's structural issues long term about the trajectory of these deficits, but it's not that singularly, not just a US thing. I mean, I think, look, the US thing was just this aggressiveness of the Trump administration's policies. I mean, they're horribly, on the face of it, stagflationary. Now, if we can avoid the recessionary element of that stagflation issue, then maybe the issue is going to become that they end up being the policy ends up being horribly inflationary, right? And but that's a risk for 2025. I just think, I think people are cottoning on to that there are other alternatives than using bonds in your portfolio. And there's, Jack, the number, just the amount of money in these custodial funds and the way that money is managed and the way that wealth is managed in most countries. It's 60-40, and that's what most guys, maybe it's 80-20. But when you look at, these wealth managers and trillions of dollars that they contain, most portfolios have got quite large sovereign bond exposure in there, right?
Yeah, and when you said you had a large client who was not enthusiastic at all about the long end of the U.S. bond market, I thought, oh, well, his client is a hedge fund, and of course they're not bullish on duration because the carry is very minimal. But no, you're actually talking about a real investor. So, a bond fund or something else like an insurance company. I mean, that really is the heart and soul of the long duration bull market that we had from, I mean, really since probably 1981 until 2022. But is real money, insurance companies that have millions of 50-year-olds who, they're taking out the actual tail. They need 30-year duration assets to match their liabilities.
Yeah, I mean,
the market is not that strong anymore. That's a big deal.
No, I think that's beginning. This was an overseas guy, so they didn't have to take that US exposure, right? So they're hedging back into a different currency. Look, I mean, I think there's a reason why we've seen yields come up to 5% a couple of times and then they back off. There is still that long dated demand there, Jack, for, as you say, to sort of asset liability matching, for certain entities. There's obviously been, the bond market's done recently better because we are concerned about the loss of momentum in the employment market, right? But we've come all the way back, 10-year yields have come all the way back to 4%. And my inclination at this level is to kind of be short bonds here, right? To bet on higher yields again, not really press that recessionary thing, because I don't see it, Jack. I mean, I think there's fragility in the system. That's why I'm very skeptical about the Goldilocks outcome, right? That we'll just manage to get just enough weakness, but not too much weakness, right? But right here, right now, I mean, certainly when I look at an equity market, I think it's utterly incongruous with a bond market, with bond market pricing as many rate cuts as it is. And until that equity market really cracks, right, I'm not going to get overly bullish on bonds, right? I mean, if you drop the equity market 20%, sure as hell, I want to be long some bonds, right? But judging by today and the last week or so, it doesn't look like that's the case, Jack, right?
So you're a skeptic that the interest rate cuts priced into the bond market and the Fed funds futures market, the SOFR market, are going to happen. But you think if they do happen, you think the dollar is going to weaken a ton and gold's going to go up a lot.
Yeah, look, as I said, a lot depends on whether the administration gains control of the Fed. If they do, and they and they artificially suppress yields or other things, right, to essentially mitigate the impact of yields, where they play around in the mortgage market and kind of tighten mortgage spreads, right? There's a number of instruments that they can deploy, and they seem highly determined to pursue their approach, right? It's a bit like the IEEPA tariffs, right? What if the Supreme Court, strikes those down? Are they just going to go, okay, I surrender? No, they're going to try a different tack to pursue the same end game. In that environment, Jack, if we look at, do they not get Lisa Cook? If they don't let Lisa Cook, is there someone else they can go after, right? They seem quite determined to be able to say, aha, on your college, exam when you were, 18, you cheated, right? You're out. You're, whatever they need to do, they are determined to try and gain control. I'm not saying it's wrong. I'm not saying it's right. My job is to just figure out the consequences. So I think if they do that, Jack, yes, I think you can go straight to the reflation trade. You get a weak dollar, right? And then asset prices rise, but typically within that environment, you don't own tech stocks, you own mining metals, you own commodities, you own overseas assets. Those are typically ones that outperform. If the Fed fights the noble fight somehow and the administration don't, then I think that process to that end game, because I don't think it's avoidable, a weak dollar, is more complicated. And we could end up with an equity correction if the Fed really stands their ground, right? If I'm right and growth starts to truly accelerate next year, Jack, and the unemployment is not rising again, but it's falling, and the Fed goes, right, I'm sorry, we're still an independent Fed. You've got a couple of people on this board that you think you can manipulate, but you know what? Screw you, right? We're taking a stance. Then I think you could get a big equity correction. And then out of that, I think will be born a very weak dollar as they have to do anything. Because I think the sensitivity, one topic we haven't covered, Joe, I have to say that I truly fear that the US economy is essentially a leverage play, and I mean the whole economy, a leverage play on 7 stocks. And if those 7 stocks, for whatever reason, it's a bubble, they just go down, who knows, really crack, Jack, I think we could see US growth, confidence, all driven by wealth effects, implode.
And I'd say 4.5 of those magnificent 7 stocks are really dependent on the AI capital expenditure build out. I'm pretty bullish on the AI CapEx build out. I'm pretty bullish on semiconductors, but my even higher confidence view is that if the AI CapEx build out doesn't do well, I don't think the stock market is going to do well, because that is the one thing that's objectively doing really well in the US is people buying a lot of semiconductor chips and building out data centers. Everything else is kind of wishy-washy. As you say, labor market, maybe not super weak, but it's fragile. The consumer spending that was super strong for 4+ years, is now beginning to look less good. Everything that contributes to GDP and an economy is kind of fragile, except for AI capital expenditure.
Right, so, and I think we have to remember, Jack, Amazon's got a big consumer-facing side of its business. Google and Meta at the end of the day are heavily advertising companies, right? And ad spending typically gets slapped if you go into recession. So I don't think these guys are, immutable, non-cyclical stocks. I think we think they are from COVID, where I called them like ersatz bonds, where they became like a replacement to the bond market. But that's only because we printed trillions worth of dollars worth of QE going in there. And I think if we weren't doing that, because let's say we've got a problem with inflation, right? Then I don't think it's necessarily that those guys would perform. And I think the bigger question for me is not necessarily the build out on this AI CapEx, it's the return on investment, right? I've no doubt that AI is going to be hugely transformative over time. But I think we are beginning to see signs that it may take longer than we think to harness and learn how to use a new technology, and that there are perhaps limits around that technology. And I know, people get very hyped about, things like, Tesla to me, for example, is a classic hype stock. I mean, I don't think there are investors in Tesla outside those who have to own it as part of their, as part of the index, right? I think they're basically disciples, right? To me, a thing trading on the PE that it's trading on hopium, that, the robot's going to deliver or autonomous cars are going to deliver, when you can actually read the stories that, there was some influencer who set off to go coast to coast in his Tesla the other day and crashed after 60 miles, right? So I just, I think there's a lot of hope built into this market, Jack. I'm long, I'm riding it, I'm holding on, like going up the, I don't know how long that roller coaster top goes. I hope a little bit longer, right? I'm betting on I'd like to see silver hit like 50, 55, which is still a decent chunk, right? But the fall will come. I'm not betting on it now. And I worry about how leveraged. I worry just, when I look at the US, we have never, ever, ever been so dependent, Jack, on wealth to drive consumption in this country, right? It is arguably not arguably, it is morally wrong that 10% of the population who derive almost all of their money from wealth are 50% of total consumption and rising as a proportion. And they are all of discretionary spending, because most other people have no discretionary spending. The check comes in, it goes out, right? Just imagining what would happen if you get a 20% drop in the equity market, and one that can't be immediately printed our way out of it because it comes about, let's say, by inflation.
One that sticks, not one like the Liberation Day in April.
Yeah, right? What happens to wealth spending then, right? If those wealthy people cut their spending in half, right? And don't go to the restaurant, or don't buy the new car, or don't, right, go on the holiday abroad, right? You just imagine what could happen. And then, you know, CEOs will look at their stock price, they'll do their usual thing, they'll go, oh, my job is basically to be, you know, a champion of my equity price. Well, I better start cutting costs. And so then you get your capex cuts, and then you get your employment cuts, and the cycle, you know, I just think it's an incredibly dangerous and fragile cycle, Jack, which is why I really shake my head when I sort of go, you know, oh, it's nirvana, we're going to get this Goldilocks outcome. Maybe the one get out of jail free card, definitely productivity, but it isn't apparent yet in the data. I think it's coming, but it typically takes longer than you think.
So you're a bull on gold, but you're bearish on Goldilocks.
Yeah, I am. I mean, I'm riding it. I'm riding the Goldilocks train for now, but I'm skeptical of Goldilocks, Jack. I'm very skeptical of Goldilocks.
I don't value what my own opinion is very much on this show, but yeah, I also am riding Goldilocks, you know, in my personal account, but I'm also skeptical of Goldilocks. Julian, you say about Tesla, like Tesla's revenues are down from 2 years ago. So just to give a little empirical boost to your point there. So I think they are dependent on the car market getting a lot stronger than it is, or the robotaxi thing that they've been talking about for a very long time, or the humanoid robot thing. Julian, I got a question about you. You said you've got concerns about return on investment for AI capital expenditure. So Google, Microsoft, Amazon, Oracle, all these companies that are spending billions, tens of billions, in some instances hundreds of billions of dollars on NVIDIA chips, as well as the data center build out. You have a concern that they're going to get a return from those investments. But Julian, what if you, a smart, reasonable person, other smart, reasonable people have that concern about ROI, but what if the people who are writing those checks don't have those same concerns? And I'm just pulling up something from Twitter, like Mark Zuckerberg on a podcast recently said, you know, yeah, looking back at CapEx cycles, you know, typically there is a little bit of an overbuild. So, you know, it's possible we do spend, you know, we do waste, hundreds of billions of dollars. But ultimately, like, I think there will be, you know, if the cycle turns, we can get some of those assets on the cheap. And Larry Page, you know, creator of Google, said, I'm willing to go bankrupt rather than lose this race. Interestingly, Google, I think, is actually the best capitalized company in the world in terms of cash on its balance sheet. So it's, you know, the least close to bankruptcy, but they are, you know, all these companies, Julian, are just spend, and they're, you know, you're concerned about ROI. No offense, you know, they're not listening to you. They're not really listening to the people.
No, Jack. I mean, I do think, you know, I think, you know, there is an existential threat to these companies if they don't invest, right? Yeah. I mean, I think the question is given some of the valuations, you know. I mean, you're looking at Tesla, right? I mean, Tesla's gone from a PE in March of 125 to 270. Right?
Yeah.
You know,
for a company whose revenues is declining, like if a company's EPS goes from negative 1 penny to 1 penny, in some instances, an on-paper PE of 150 like could be appropriate, but this is not the case of Tesla. Right. Yeah. But the question is, what if all of these people, it is a capital expenditure bubble, but and like, you know, NVIDIA.
Jack, I mean, the question is right. Let's just say, and this I do think this is the case. I think it is essential for Google to invest and Meta to invest so that Google remains number one in search and Meta remains number one in social media. Mm-hmm. Right? What I'm not certain of is whether what comes out of this is any more than that, right? Is some new product or some new massive revenue stream, Jack, which catapults these guys to having much bigger structural gains, right? I personally think Zuckerberg, apart from his first clever deal from university, is really as bright as we think he is, right? This is a guy who invested in the metaverse, right? Total failure. Who's investing in bloody AI glasses, yet to be seen whether that's anything. And I just think he's a wealthy guy who just throws shit at the wall and see if it stinks. It sticks, right? And what worries me is, as I said, do we end up with completely new revenue streams that come out of Google, Amazon, Meta, whatever? Or do we just end up with the behemoths that just dominate their space and have had to spend on AI to keep dominating their space? But yeah, they got better at it and they got a bit more efficient at it, Jack. But somehow it just doesn't give you that like nirvana breakthrough of accelerative earnings. And that's, or at least not yet. And that's my concern, because if you look, I'm very happy to think about companies that may do extraordinarily well from deploying AI and buying those. But the problem is our equity market is dominated by the companies that are spending on AI and assume to get this new revenue.
Yes.
Right. And that's the risk. So Cisco was transformative in 2000. Microsoft was utterly transformative in 2000. We just paid too much, right? We just paid too much for those, right? And that's the problem. I'm not saying we're quite there yet, so I'm still long. I'm still chasing this thing. But we've seen technology that's utterly transformative. It does not mean as an investor you always make money from the investments, right? Whether it's the railway bubble, in the late 1800s, whether it's the dot-com bubble, whether it's just a lot, Jack.
So Julian, what about, do you see stuff in the equity market outside of the Magnificent Seven, outside of Nvidia and Broadcom, but particularly I'm talking about junk companies, extremely speculative stocks? You referred to silver miners that were and are speculative, but the price of silver has doubled. I'm talking about companies that have no revenue, or they're a crypto treasury company where their business is buying crypto, which doesn't sound like it doesn't sound like a non-cyclical business, to put it lightly. And these are the stocks that are going up most as we're recording today. Quantum computing stocks, which some artificial intelligence people say is totally fake, that has no commercial use case. Not that it's fake; it has no commercial use case. Do you have concerns in the same type of stuff that you were seeing in 2021 that says this bull market is just how much more speculative can it get? It's getting too crazy.
Yeah, I do, mate. I absolutely, definitively do have concerns, right? I mean, look, I'm not a single equity guy, but I've looked at, say, MicroStrategy and just gone, what? Look, I mean, there was a slight value of MicroStrategy, for example, trading at a premium, because for many Europeans, it was impossible to buy crypto. So you could basically buy crypto via MicroStrategy, right? So if it traded roughly at like a 20% premium, which was the case, through the beginning of 2024, fine, right? But then it just went parabolic, right? A sailor was like, well, I'm going to do this. And mate, at the end of the day, you own crypto. Why would I pay up to own your stock?
Yeah.
Right? Well, that's all the guy does. And so
Tom Lee is doing that now. So the second largest company is Tom Lee has a company.
Right.
So, yeah. Doing that with Ethereum.
Yeah, fine. All right, great. I'm an idiot. I should have a Julian Brigden balls to the wall long junior silver miners ETF, right?
Yeah.
And I just listen to these analysts, and I'm not a big analyst fan. I think they're basically ambulance chasers and momentum chasers, and they're beholden to the sort of they're bankers at most of their firms. You have to say nice things, or they don't get on the conference call and don't get the M&A deal and all this sort of thing. So I'm just not a big fan. But when I look at, yes, you're absolutely right, Jack. When you look at some of these things, they're kind of crazy. But the game keeps going until someone takes the punch bowl away, or we all fall over drunk, right? And like I said, I kind of think silver's got another 20%. So that means probably my junior silver miners have got another 30%, right?
Yeah, I don't know anything about the technology, but I have looked it up, and apparently silver has some use case in AI. So there is an angle there. That's
Whoa!
Yeah. Boom. Julian, I want to ask you, earlier you referenced the Federal Reserve. many viewers and listeners we have here today will be familiar with President Trump's attempts to remove Federal Reserve Board of Governors Governor Lisa Cook for the mortgage thing, that perhaps the Treasury Secretary Scott Bessent may have done something somewhat similar in the past, as well as Adriana Kugler, Board of Governors, resigned for reasons that we are not aware of, and Stephen Myron, who I have interviewed in the past, the former Council of Economic Advisors, is now an acting Federal Reserve governor, and so he was appointed by Trump, and was working for Trump. So those are the two attempts at potentially the administration putting its little, its grubby little finger, so to speak, in the Federal Reserve's nest. I wasn't aware until 30 minutes ago, you said, Julian, that there's this regional Federal Reserve president angle. So the 12 people on the FOMC are the Board of Governors. Then the New York president is always a voting member, and then 4 of the 11 Federal Reserve Bank presidents. All of those Federal Reserve Bank presidents I just looked it up, are set to be replaced in the end of February in 2026. You're saying that the administration is trying to get Trump-friendly people in those roles, or if not Trump-friendly, dovish people in those roles. That's what you're saying.
Jack, that's what I've heard on the jungle grapevine, right? Yeah. That there is arm twisting, talks going on with, because they're basically selected by the local boards, if you so yes, that's what I'm hearing. I don't know whether it succeed, Jack, but look, I think this is an administration which I think, and this is what I find amazing, is this sort of assumption that we're in Kansas, when it comes to sort of policy. Oh, nothing too dramatic. And I'm like, what? Have you not looked at what? Have you not looked? I mean, everyone, like I said, everyone sort of said to me back in November, no, Julian. Then, they're really not going to do anything radical. I went, they're really going for it, right? And yet we sort of look at this and you just go, this is an administration that has a singular focus on achieving its objectives, right or wrong, a singular focus. And you don't think if they get blocked one way, they're not playing another angle? I mean, I just think that's stupid. I mean, I think that's just ridiculous, Jack, right? These guys are going to push and push and push and push till they do it. Now, can they do it? Will they do it? Will it take a little bit longer? Maybe, mate, right? Maybe. And that, I think, will have important market consequences, but we'll see. But I think don't question whether they're going for it, because they absolutely are going for it.
Right. Yeah. The administration, relative to what it looked like in March and April, to me, has turned out to be less muscular on DOGE, less muscular on tariffs relative to how it looked to me in March and April. But I think Trump, he is far more aggressive on getting involved with the Federal Reserve, let's put it that way, than I thought. And that is a market risk to interest rates going down. It's a market risk to the dollar. And the president himself has the president is on your side, Julian, of a weaker dollar. He has said it and basically implied it.
Yeah, I mean that's what they want. I mean, it's how you reset. Look, Jack, we can't go along and spend 6 to 7% budget deficit and run a 4% current account deficit, right? Remember, that's a shitload of money, 4% of GDP, right? That's sort of $1.2 trillion a year, trillion, that foreigners have to fund every single year. Another 1.2, another 1.2, another 1.2, another 1.2. And, this is when you end up getting problems, right? You end up, Scott Bessent said, I kind of want a weaker dollar because I don't want a situation where all the money piles up in the US and we end up with a bubble. Well, I'm sorry, Mr. Treasury Secretary, I think it's kind of already a little bit too late, and arguably we're already going in that direction. I'm not saying we're there yet, right? But the idea that we come out of this and it's like we're all holding hands and skipping along and we've just got everything absolutely right. and unemployment's just holding in there. It's not going up, it's not going down too much, and there's no inflation, and they're still cutting. I mean, that's the stuff of fairy tales, mate.
Julian, as I mentioned in the beginning, your research service, Macro Capture, as part of MI2, is a research partner of Monetary Matters. So Monetary Matters listeners can get a 10% discount with coupon codes MM10 for annual and MM10Q for quarterly by clicking the link in the description. So Julian, we've talked about some of the trades that have worked so far for this year. The bearish dollar trade, obviously, that's worked out very well. The XME trade being long, the metals and mining ETF, gold, silver, your silver minings. But what else are you looking at right now? Because Julian, most of this conversation we've had has been basically the two forces fighting. Number one, the force of the administration and potentially the Federal Reserve cutting into a reacceleration that could be a reacceleration of inflation. So basically, that's running things very hot. And then the other force is a potential recession. So I think those two forces would, depending on which one succeeds, is going to lead to ultimately very different trades. Maybe gold continues to work in both of those trades, but what other trades are you writing for your clients at MI2 and Macro Capture, just to give people a little bit of a taste? Is long China, long Europe. What else is going on in that brain of yours?
So we've been long sort of Europe one, we like some of the emerging market plays too, in the equity markets. Some of these equity markets are actually quite cheap. So if we continue to see dollar weakness, as I said, I want to see it, Jack. But I think, I like that. I'm a little cautious, and probably a bit too cautious, because some of these I've run as relative trades. So we've run sort of long Spain and short the S&P, right? It's been a good trade. But I probably could have just lifted the Spain bit. That lifted the leg on the S&P and not run that short. But, we run trades in the book, as opposed to, so we try and risk manage them properly for people. But what we write is also designed to give people help into sort of as they manage their individual portfolios, right? So as I said, I'm looking at things and waiting to see where we end up. I have a feeling, Jack, as we move, if this run up continues, I think we're going to start to see pressures start to build in risk assets. So run up in risk assets. If this run up in risk assets continue, I think we're going to start to see pressure build in the bond market. And so that's an area that I'm watching quite closely. And if obviously it gets too acute, I'm worried that it will lead to problems in the equity market. So I think, I like the existing structure of the stuff that we have at the moment. I think we're well positioned. I think these trades are structurally in their infancy and are worth holding for multi-year periods. But I think we may have to start being nimble if things were to start to really, get really excessive. I'm not going to, we had some tactical trades beginning of the year where we sold some S&Ps. It actually hit. We said, "Oh, it's going to 4,800." It went to 4,800. I mean, better lucky than smart, Jack, right? But guys, look, you cannot run an ever-increasing rally in risk assets without, at some point, paying the piper, right? You are going to pay the piper, and exactly when that is, we will see.
Right, and Julian, three sort of winds have been blowing at the same time for many months now. The dollar weakening, the U.S. stock market rallying like crazy, particularly tech stocks, and gold rallying. Those three things don't often happen at the same time. And
no, Jack, I mean, and this is the problem with gold. Look, I love gold. I think the thing can go a lot higher over time. But if we were to walk in and the NASDAQ were down, God knows what, right? Then there is no doubt that gold would be down or could be down, right? Because it's owned, right? This is the problem. When we get these risk-off events, which market professionals tend to call VAR events, right? These sort of those volatility shocks across trading books, right? There's no doubt that the shit is owned by people now. We own everything, right? We own everything. So, that's when, I would, if I'm looking at something, as I said, it's a question of, how do we get to that crack? Is it first we need to see rates rise first, then it breaks, and then we rush in and buy bonds, right? Or is it unemployment? I'm wrong, and unemployment does suddenly start to really jerk higher, and the equity market has never been up. And like I said, you go back to 1920, there's not a single recession in the US where the equity market was up. Not one. Even in COVID, initially we were down hard, 20%.
Yeah, that recession lasted 1 month. Yeah.
Yeah, right? So there's not one where it's up, right?
Julian, I'll just challenge you for the sake of argument about gold. I'm not doubting that a lot of people are long gold, but is it really in the US? So I'm just looking at the AUM.
No.
Looking at the assets under management of the big gold ETFs as well as the big gold mining ETFs, assets are up. AUM is up less than the price, which means as this market has been going up, people have been pulling money. There have been outflows, not inflows. So is it just a bunch of people in Japan and particularly China who are buying, and the bull market in terms of allocations in the US is only in its infancy? That's my potential.
Yes. I think that's the case, Jack. I mean, as I do. I just, we've talked about this kind of nature of the rotation. Is it nice? Is it nasty? Right? Typically to end up with true precious metal bull markets, so autonomous periods where precious metals are materially outperforming other assets, are the product of a nasty correction in equities, right? So in that transition period, gold will outperform in an environment where the S&P is falling. So let's say in 2000, that's what happened. But it doesn't mean that gold is going up. It might, if you're lucky, it goes sideways. But silver certainly typically goes down because it's a higher beta asset. It doesn't go down as much. It may only go down 30% to an S&P that goes down 50%. But it's bloody annoying if you can't own it as a hedge fund if it goes down 30%, right? So there's a tactical way to kind of play this thing. I'm not selling my gold anytime soon. I'm not, but I have got books. I've got, I trade my 401k quite aggressively because you don't pay tax on it, right? Yeah. And on that one, I might cut at some point all my gold, all my silver, and just go to cash if I think there's a big risk off event. I don't think it's right here, right now, but we will see.
But you're the type of trader and analyst who, if it goes up $100, you could get back in. I think often in the equity market, it's fine to sell if you're willing to get back in when it goes down, and you're willing to get back when it goes up and buy higher. And that's a skill I'm slowly acquiring. But I think, people don't want to be the person who sold and looked like a genius before a 15% pullback in the equity market, but they never got back in on a long-term basis.
Yeah, I mean, that's the trick, right? I mean, that's what you have to, you buy when the blood's in the street.
Blood is not in the street right now.
No, not at the moment, mate. Not at the moment. No, I think that's fair to say.
All right, Julian, we'll leave it there. People can find you on Twitter at JulianMI2 and mi2partners.com. For 10% off Monetary Matters, listeners can go to the link in the description and get a coupon code with MM10 for annual and MM10Q for quarterly. Julian, thanks again. Until next time.
Pleasure, Jack. Thank you very much indeed.
Thanks for watching. As a reminder, this episode of Monetary Matters is brought to you by SMH and SMHX by VanEck, two complementary or standalone semiconductor ETFs that give investors targeted access to the full spectrum of AI's growth engine, from manufacturing muscle to design dominance. Go to vaneck.com/SMHJack and SMHXJack to learn more. Until next time.
Thank you. Just close the door.